Share podcast with our host, Ed Lyon. Ed, how are you? And you know what? I'm just know I'm going to get a lion's share of knowledge from you.
Well, don't you want to keep the lion's share of what you make?
I totally do. And so tell me how it all works because I really want these secrets so I can save money.
Right. So let's lay down a foundation for understanding everything we talk about on every future episode of the Lion's Share podcast. And that is, how does the tax system work? How does the tax planning process work? The tax code is thousands of pages long. You can literally buy it as a book. And that's just the start. You've got treasury regulations, you've got tax court cases, you've got federal court decisions, you've got IRS publications, pronouncements, memos. It really is a nightmare to keep up with all of it. But you really can reduce the tax code itself down to something that a kindergartner can understand. So the tax code is a series of red lights and green lights. The red lights are where you have to stop and pay tax. The green lights are where you can go without paying tax. So the process starts with the red lights, and there really aren't a ton of them. Code Section 61 says that that gross income includes every dime you make, including the change in your couch cushion and that $5 bill that fell between the console and the front seat of your car. Everything is gross income. So we're lumping it all in to this big under this big umbrella. Code section 1 says here's what the tax brackets are. Here's how much you have to pay depending on your filing status. Code section 3101 says here is the Social Security, the FICA tax. Code section 1401 says here's the self-employment tax. Different sections have the alternative minimum tax and the net investment income tax. That's really about it, though. There aren't a whole lot of red lights. They're just very broad and all encompassing. You pay tax on everything. But then the tax code switches pretty quickly to green lights. The green lights are where you don't have to pay. So section 105 says gross income does not include amounts that your employer pays to reimburse you under a medical expense reimbursement plan. And if you're self employed and you hire your spouse to help manage your business, maybe you can pay them in the form of a medical expense reimbursement plan and write off your kids' braces as a business expense. Problem is, your CPA probably didn't tell you that you can write off your kids' braces as a business expense. Code section 161 lets you write off ordinary and necessary business expenses. Code section 170 lets you write off charitable gifts. If you're saving for retirement, one of your choices is going to be, do you save in a traditional qualified plan, or do you maybe use a life insurance based retirement plan? Well, Code Section 7702 says you can withdraw money from that life insurance plan tax free. So you can see you've got the red lights, stop and pay, the green lights, go without paying taxes. I've spent 20 years teaching CPAs and financial advisors how to find green lights. That really is the key to what makes my tax planning approach different. Most CPAs focus on the red lights, and that's important, right? You blow through the red lights, that's how you get in trouble. But by the time they're done with your tax return, they're either too busy or they don't have the training or they don't have the proactive mindset to go looking for the green lights. So when I sit down with a client, whether it's a guy like you or anybody else, I'm going to look for the green lights where you can go without paying tax.
Hmm.
And here's something else that's important, and this is why I talk about mindset so often. You live in Ohio, doesn't matter what state you live in 50 states in the country, you can turn right on a red light. Well, the tax code gives you lots of opportunities to turn right on a red light too. So if you come to me and say, Ed, I want to put $30,000 in my Roth IRA this year. Typical accountant is going to say, you can't do that, Neil. First of all, the most you can put in a Roth IRA, it's a much lower limit. And second, your income may be too high. You may not be able to contribute to a Roth IRA at all. But I'm going to look for what we call a backdoor Roth IRA. Maybe you can put the money in a simplified employee pension and then immediately convert that to a Roth IRA. So even if we're at a red light, we're first going to look for the green lights. And if we can't find the green light, we're going to look for a way that you can turn right on red. But fundamentally, that's how to understand the tax code. Yes, you've got the red lights. Let's look for green lights. And the tax code has way more green lights than red lights.
You know, Ed, when I look at the tax code, I see thousands of pages of gobbledygook.
Yeah,
What
exactly.
am I missing?
Right. Well, and what you're missing is that approach. So the thousands of pages of gobbledygook, to most people, it's going to intimidate them, but that's where the red lights are hiding. And we're seeing more red lights being added to the tax code all the time. So right now Congress is looking at the big beautiful bill. We're recording this on June 25th, and the big beautiful bill is in the Senate, and one of the provisions from the big beautiful bill is no tax on tips, right? So it's a limited green light. It would apply only on $25,000 worth of tip income, and it only lasts through 2028. But that's a new green light that Congress is looking to create for tip income. They're looking to create a new green light for overtime income. They're looking to create a new green light for retirees who are paying tax on their Social Security income. And so they're looking to structure a new higher standard deduction for them. So yeah, it's dense, it's impenetrable. I often tell my clients when they marvel at how complicated it is, I say, yeah, this is now you know why tax lawyers drive Jaguars. But the key is you're looking for those green lights and you're focusing on the green lights rather than just recording history, which is what most tax people do. I can't tell you how many times I've met with a CPA and they say, I just do tax returns. I don't do tax planning. They're recording history. Well, I want to help you plan. And would you trust your future planning to a historian? Probably not.
How should my tax strategy fit within my overall financial strategy?
Well, that's a really important question. And that's why I focus on holistic planning. So every financial decision you make has a tax consequence, even if that's just buying a soda at the gas station when you gas up your car or your truck, because you're going to pay a sales tax on it. Every business decision you make, every investment you make, there are going to be tax consequences for all of those. So if you want the most efficient tax plan, you have to start at the top. You have to start with that 30,000-foot view. There are a lot of people in the tax reduction space where I work. I call them hitmen. They've got one weird trick that melts taxes away. Maybe it is a captive insurance company. Maybe it's a version of a 401k plan. Maybe it is the Augusta rule or a cost segregation study for your real estate. They're all good hacks. They're all good weird tricks, and I use them. I work with a lot of these hitmen. But that's not comprehensive, that's not holistic. And if I sit down with you and I tell you, oh, here's something that you can do with cost segregation, that may not fit with the rest of your plan. Maybe you're planning on selling the business in a taxable sale in 3 years, and you're just going to have to recapture those savings. Maybe the cost segregation study doesn't make sense for you right now. So, in my research on tax podcasts, I looked at a lot of podcasts from CPAs, from EAs, and they say this is the tip of the week or this is the hack of the week. And those are, they're valuable strategies. They're valuable strategies, but the question is, are they the right fit for you? So, where does tax planning fit in your overall finances? If you have a financial plan, you should also have a tax plan. If you're building up a 401k war chest to retire on, what are you going to do about the taxes when you're in retirement? If you're investing in a business and you want to sell that business down the road for millions of dollars, how many of those millions are you going to keep after Uncle Sam and your state government take their share? So every one of these financial decisions that you're working towards has a tax consequence.
Let's assume, well, I am a business owner and I'm looking to pay less.
Right.
How would that process work?
Okay. So this is where the rubber meets the road. How does a formal tax plan come together? I'll tell you how I do it. And this is how I've taught accountants to do it since 2005. Some people do it differently. But so you're going to discover through this podcast journey that we're going down together, I love analogies. And the analogy I use is the tax planning process works like what happens if you don't feel well and you're going to the doctor. Typically, that's going to involve three phases. First, the doctor is going to diagnose the problem. Let's say your stomach hurts. Maybe you just got some bad blue cheese in your salad last night. It's food poisoning and it's going to pass. Maybe it's something more serious like pancreatitis or gastritis. Maybe you've got contagious death cancer and it's time to start getting your affairs in order, right? Either way, you got to know what's wrong. Second, the doctor is going to write a prescription because most problems don't solve themselves. And then third, somebody is going to fill that prescription. Maybe it's a surgeon, maybe it's a pharmacist, maybe it's a physical therapist, maybe it's a massage therapist. But diagnose, prescribe, fill the prescription. So with me, the diagnosis is I'm going to find out what your situation is. Where are you now? Where are you hoping to go with your business, with your finances, with your investments, with your rental property? What are you looking to accomplish? And then, just like a doctor, I'm going to look at some scans. I'm going to look at your tax return, your business and your personal tax return. And what I'm looking for are mistakes and missed opportunities. If you've got a competent accountant doing your taxes, I'm probably not going to find outright mistakes, but I'm going to find a lot of missed opportunities. Then I'm going to offer to write a prescription. And that's going to be different for every client because different clients have different income levels. I'm going to look for a number that I can guarantee in saving. So if you're a business owner and you paid $100,000 in taxes last year, I might be able to offer to save you $30,000. But I'm going to guarantee those savings. And then I'm going to quote a fee. And that fee might be, let's say, $15,000. The fee is tax deductible. So the out of pocket cost might be $10,000. $10,000 in fee to save $30,000 guaranteed. That's a pretty good investment, 3x. And the guarantee would be within 12 months. And then at the end of the year, we're going to look at how much you actually saved. And if you save 30,000, great. If you only save 24,000, if you only save 80% of that guaranteed amount, well, I'm going to refund $6,000 of your fee. That way it's a heads you win, tails you don't lose proposition. I take away the risk because my clients, they're used to paying accountants. They're used to paying attorneys. They're used to paying consultants. Heck, they're used to paying plumbers to come and fix their plumbing. There's no particular risk in hiring someone to do that. But when they sit down with me, this is the first time somebody's asked them to write a check or a series of payments for a tax planning fee. Naturally, you're gonna feel some risk, right? You're gonna want to make sure you get your money's worth. So the money back guarantee reassures you that you're going to get your money's worth. And then I'm going to work with you, with your CPA, with the CPA firm that I refer people to. We're going to work together over the course of that year to make sure that you actually get those savings. But you're going to see the initial architecture up front. So you're going to see a waterfall of strategy. If you own a business, we're going to start with strategies at the business level. How can we keep income from hitting your 1040? Then if there's still income hitting your 1040, and in most cases there will be, we're going to look for ways that we can offset the income on your 1040. Sometimes we don't want to eliminate all your business income. If you're expanding and you're borrowing money from the bank's going to want to see that you're making money so that you can pay them back, right? So we may want to show a pretty high adjusted gross income, and then we'll work on below the line strategies that can offset that income. But it is a discipline. It's not just, oh, we're going to bring two or three hacks to you. We're going to look comprehensively. So I look at your business structures and your entities. I look at executive compensation, qualified and non-qualified retirement plan, real estate operations, investments, charitable giving, exit strategies. And then if your net worth is high enough that you're looking at an estate tax bill, I want to make sure that the income tax strategies play well with the estate tax strategy.
This is great stuff. Are there any specific go-to strategies I should be looking for?
So that's a question everybody asks. And my answer is it depends. The question that drives me nuts, Ed, quick question. I'll give you a quick answer. It depends. There really aren't any quick questions because I'm not interested in just giving you a strategy. I'm interested in tailoring the strategy that's going to be best for you. So for businesses, we want strategies that are going to keep income off your 1040. We want to move income. Most people who run a business, who are going to listen to this podcast, they operate their business as a pass-through entity. It's either a proprietorship, a partnership, or an S corporation where the income ends up on their 1040. Well, if we can find ways to move the money where it doesn't end up on your 1040, that's a good first line of defense. Then once income has hit your 1040, we want to find ways that we can create offsets. But there is no specific go-to strategy that I take to every single client. There's no magic bullet.
Because it's on a case-by-case basis. That's the
It's on a
bottom.
case by case basis. It's individual. It is a bespoke process, and the higher you get on the financial food chain, the more bespoke it becomes.
All right. Is there time we're recording this discussion on June 25th while
Right.
Congress is considering Trump's so-called big beautiful bill? What should listeners be thinking about as it works in its way through the process?
So I hear a lot of talk about the big beautiful bill. Here's the thing about the big beautiful bill. And we remember this because we all watched Schoolhouse Rock, right? I'm just a bill. Yes, I'm only a bill and I'm sitting here on Capitol Hill. But maybe someday I'll be a law. Well, right now the big beautiful bill is just a bill. There are some things that passed the House. So in the House, they said we're going to raise your deduction for state and local taxes from $10,000 to $40,000. In the Senate, they looked at that and they said, no, we don't like that. So they knocked that provision out of the Senate version. We don't know what's going to pass. The other thing that we have to keep in mind with the big, beautiful bill is there are a lot of non tax provisions. So the big, beautiful bill pays for tax cuts by cutting Medicaid benefits. And some of the Republicans who are going to end up voting on that bill want to see Medicaid cut. Others don't. Others don't. So you've got Josh Hawley, a senator from Missouri, who says, wait a minute, Republicans collect Medicaid benefits as well. I don't want to punish my constituents in Missouri who are on Medicaid.
Right.
So right now, it's Congress having a food fight. The goal is that they want to have the big beautiful bill to President Trump's desk by July 4th. That's not going to happen. That's not going to happen. I talk to accountants who don't think that the big beautiful bill is going to cross the president's desk until December. And some people think we're probably going to end up going into early January before they panic and say, wait a minute, it's January 3rd and we don't know what the tax rate is for January 3rd. So don't get too caught up in what happens in Congress until a bill goes to the White House for the president to sign.
Got it. Well, another great podcast, Ed. Best place to catch up is make sure you like and subscribe to this podcast on Apple, Spotify, and also go ahead and subscribe on YouTube and reach out to Ed and talk to him sometime if you have questions. And we're going to have a place for people to check out that
Yeah.
information and on social media and stuff. And we appreciate it. Great stuff.
Thanks, Neil.
All right.
Always a pleasure.
That was a special simulcast of Neil Haley Show on the Lion Share podcast, guys. Take care.